Hi, I'm David Witter, founder and CEO of Financial Harvest Wealth Advisors. Welcome. Today we're going to be talking about one of my favorite topics on how we help clients, which is gifting strategically to maximize impact. I can't tell you how often it is that when we have a new client that comes in, they usually are charitably inclined, but they haven't considered all the many ways that they can gift and maximize or dramatically increase the impact for both them and for the charity in the way that they give. So my purpose today is to answer three questions. First, why would you give? Secondly, to whom can you give? And then third, most importantly, is how would you give if you're going to be doing that? So first, let's talk about why you would give. First thing is existential meaning. It brings purpose, it brings meaning, it brings fulfillment to our lives beyond just our lifetime. Second is there's a lot of health benefits. There's numerous studies that show that those that are generous and give on a regular basis actually have reduced heart disease. They have less risk to dementia. They have more joy in their life, less health issues as they're journeying through. So there's some health benefits for giving. And third, which is the most common reason people think of when they give, is there are wealth enhancements, or what we mean by that is tax mitigation that can typically happen when you give charitably. So now, secondly, is where or who can you give to? First, you can give to a loved one, and there's two ways that you can give to a loved one. One is you can just stroke a check and give them cash. A second way that you could give to a loved one might be an appreciated asset. So here in this picture, we have an example of you may be gifting shares of stock to a loved one, where you can maybe your loved one is in a lower tax bracket. It makes more sense for them to receive that gift of stock, because if they were to diversify it or use that appreciated stock, it's at a lower tax bracket. But let me move over here to the other types or ways that you can give, which would be to charities. And this is what we see as a very common approach. So you can give cash. You can also, again, give appreciated assets. We're going to do an example on that here just in a second. But a third way that's added to the charities is you can take a required distribution out of your retirement account and gift a portion or all of it to a charity. So let's look at those two examples: appreciated assets to a charity and also required distribution to a charity, and look at how there's a dramatic impact or increase in the impact for the client or for you if you're giving to a charity. All right, let's look at an example here. If you gift $20,000 of cash to a charity, most of you are familiar with this, you can save up to 39.6% in income taxes if you're in the higher income tax bracket. Obviously, that's subject to itemized deductions and would generate somewhere around $7,900 of tax savings for that $20,000 gift to charity. But what if you gave appreciated assets, a more strategic way of giving to the charity instead? In this example, what I have here is you have $10,000 of cost basis, and then let's say $10,000 of appreciation, and you gift the entire $20,000 of, let's say, stock or appreciated mutual fund shares over to the charity. You still get the same, in our example, itemized deduction and tax savings of roughly $7,900 if you're in the top tax bracket. But notice what else you avoid, which helps with tax mitigation. You avoid the capital gains on that $10,000 gain. Because remember, when you gift the full $20,000 over to the charity, they don't pay capital gains tax. So you still get the $20,000 tax deduction, and you avoid the $10,000 of capital gains, which is an additional as much as $2,380 of tax savings. In that example, that just increased the overall impact of the gift to over $10,000 in tax savings on a $20,000 gift. So you can see dramatic increase in the impact by giving strategically. A second way we see you can give to charities, might be better than just writing a check or giving cash, is if you have required minimum distributions from retirement accounts. A simple example, let's say you have a $40,000 required distribution. If you're in the top tax bracket, you're going to pay close to $16,000 in tax. But one way that you could alleviate some of that tax is, let's say you decide to have $10,000 of your required distribution from the retirement account paid directly to the charity, and then you take only $30,000 of that distribution in your personal name. Then that reduces your tax burden. In this example, it drops it down to roughly $12,000 in tax instead of $16,000 in tax. And it's almost like a 401k deferral. You're just deferring $10,000 of that required distribution straight over to the charity and have it payable directly to the charitable name. We can also do this using donor advised funds to make it very simple for you. I know there's a complex example, But you can see those are two examples of ways that we can dramatically increase the impact of how you're giving. So what do you need to be doing now? Well, first is, because of all the benefits, give. Start small, start doing that, get into that practice of it. There's a lot of benefits to doing so. And then secondly is, if you are going to be giving, talk with us, plan before you give, because there's many different ways to do it, and many of those can provide much higher impact and be much more strategic than just writing a check or giving cash. Hope that's helpful. Let us know how we can help with maximizing your charitable impact.